As of today, Sunday, January 18, 2026, at 6:51 p.m. IST, the stock market is currently closed in observance of the weekend. Looking back at the final minutes of the previous trading session on Friday, January 16, 2026, Denison Mines, trading under the ticker symbol DNN on the NYSEAMERICAN, ended the day at a price of 3.69 USD. This reflected a significant intraday climb of 0.14 USD, or about 3.94%. While many investors see a nearly 4% jump as a standard reaction to rising commodity prices, the reality is much more complex. We aren't just seeing a temporary spike here. We are witnessing a fundamental shift in how the market values Tier 1 uranium developers as they transition into actual producers. While the common narrative suggests that uranium stocks are simply following the spot price of yellowcake, the deeper insight is that Denison is currently detaching from the broader pack. The company recently confirmed that its flagship Phoenix project is officially construction ready, a milestone that most development stage miners never actually reach. This isn't just about digging a hole in the ground, it's about the massive gap between those who talk about future supply and those who are literally weeks away from a final investment decision. Expectations for Denison Mines have traditionally been rooted in its massive high-grade resources in the Athabasca Basin, but the reality of 2026 is that the market is finally pricing in the execution premium. For years, people treated the Phoenix project as a theoretical asset, a high-grade dream that might eventually happen. Now, with grid power officially available at the site and federal regulatory approvals expected any day this quarter, the expectation that this remains a penny stock is being shattered. If you look at the recent price action, DNN has been forming a series of higher lows, a classic sign of institutional accumulation. Smart money isn't buying this for a quick 10% flip. They are positioning themselves for the mid-2028 production target. This creates a tension between retail investors who might be tempted to take profits at these levels and institutional players who see a clear path toward a much higher valuation once the first shovel hits the ground. Most people looking at Denison Mines right now are focusing on the fact that it has outperformed many of its peers over the last few months. However, the common belief that this is just a speculative run ignores the structural deficit in the global uranium market. Reality tells us that the world needs about 200 million pounds of uranium annually, yet primary production is still lagging significantly behind. When a company like Denison moves its Phoenix project toward construction, it isn't just another mining update, it's a strategic signal to utilities that a reliable, low-cost source is coming online. This is why you see so much activity on investing sites and individual brokerage accounts lately. People are moving away from purely speculative junior miners and concentrating their capital into names like Denison that have a clear, de-risked path to revenue. Speaking of moving capital, the way people manage their portfolios is changing rapidly. Whether you're using Schwab Intelligent Portfolios for an automated approach or handling everything through self-investing, the emphasis in 2026 has shifted toward tangible assets. Online investment platforms have made it easier than ever to track these movements in real time. If you're the type who prefers the hands-on approach of interactive brokers trading, you've likely noticed the spike in volume for DNN recently. The Interactive Brokers platform provides the kind of deep liquidity data that shows large block trades are becoming more frequent, suggesting that the smart friend in the room is buying the dips while the average retail investor is still debating the entry point. Interactive Brokers' fees are competitive enough that even smaller players are getting in on the action, but it's the institutional-grade data that really tells the story of Denison's current momentum. The recent trading volumes for Denison Mines stock have been particularly telling. We've seen days where tens of millions of shares change hands, often on days with no major news. This suggests a rotation of capital. Investors are looking at the massive gains in Nvidia stock or Apple stock and realizing that at some point they need to diversify into hard commodities that provide a hedge against inflation and energy volatility. While Tesla stock might dominate the headlines for its role in the EV transition, the nuclear sector, and by extension the uranium miners, provide the baseload power that makes that entire transition possible. This is the hidden side of the green energy trade that is finally coming to light. Comment below how many shares of Denison Mines you currently hold and whether you think the $4 USD level will act as a major resistance point or just a speed bump on the way to new highs. When we look at the brokerage landscape, firms like Fidelity are seeing a massive influx of interest in the energy sector. Whether it's through the Fidelity mobile app or the more robust Fidelity trading platform, users are increasingly searching for ways to play the nuclear revival. Fidelity investments have long been a staple for long-term holders, and their offerings in Fidelity ETFs and Fidelity mutual funds often include significant weightings in uranium producers. If you're managing a Fidelity IRA or using Fidelity Wealth Management, the conversation has likely shifted from if nuclear is part of the future to how much exposure you need. The ease of use provided by the Fidelity brokerage has allowed a new generation of investors to move beyond the high-flying tech names and find value in the ground. At the same time, platforms like Robinhood have democratized access to these types of stocks. Using the Robinhood app for Robinhood investments has made it possible for anyone to pick up Robinhood fractional shares of companies like Denison. While some might dismiss Robinhood stock trading as purely speculative, the reality is that many younger investors are using the platform to build serious positions in the energy sector. They're also looking at Robinhood Crypto and Robinhood Cash Management to round out their financial lives, but the core of the growth is coming from people who realize that a $3.69 stock like DNN has a different risk-reward profile than a trillion-dollar tech giant. It's about finding that sweet spot where a company is small enough to grow significantly, but large enough to have a proven world-class asset. SoFi is another major player in this space, with SoFi Invest and SoFi Investing Tools providing a streamlined experience for those who want a mix of active and passive management. Whether you're looking at SoFi stocks or exploring their own SoFi ETFs, the platform's focus on active investing fits perfectly with a volatile commodity play like Denison. The SoFi Robo-Advisor might handle the broad strokes, but for those using the SoFi trading platform to pick individual winners, the attraction to Denison is clear. It's a pure play uranium bet with some of the best economics in the business. Now let's look at what Denison Mines actually does for those who might be new to the name. The company is primarily focused on its 95% interest in the Wheeler River project in northern Saskatchewan. This isn't just any mining project, it's home to the Phoenix and Griffin deposits. Phoenix is particularly special because it's being designed as an in-situ recovery operation. In standard mining, you dig up the earth and process it. In situ, you circulate a solution through the ore body to dissolve the uranium and then pump it back to the surface. This method is much more environmentally friendly and, more importantly for investors, significantly cheaper than traditional underground mining. The reality of Denison's business model is that they are sitting on a resource that could produce uranium at a cost that beats almost anyone else in the world. The tension in the current valuation comes from the recent capital cost update. Denison recently updated its initial capital cost estimate for Phoenix to $600 million USD, which is a jump from previous estimates. In a world of high inflation, this was expected by the smart money, but it caught some retail investors off guard. However, the reality is that the project's net present value remains incredibly robust at $1.57 billion after tax. When you compare a $1.57 billion project value to the company's current market cap, you start to see where the opportunity lies. The market is still discounting the project because it isn't running yet, but as each month passes and another regulatory box is checked, that discount should shrink. Looking ahead, the catalysts are lining up. We're waiting for the final federal environmental and licensing approvals, which are the last major hurdles before the construction phase officially begins. If these arrive in the first quarter of 2026, as the company expects, it will trigger a whole new wave of buying. Beyond Phoenix, Denison also has a 22.5% stake in the McLean Lake Mill, which is one of the world's most important uranium processing facilities. This gives them a layer of strategic importance that most juniors can't match. They aren't just miners, they are part of the critical infrastructure of the Athabasca Basin. The future outlook for Denison Mines depends on two main things: successful execution at Wheeler River and the continued strength of the uranium market. On the macro side, the reality is that nuclear power is the only baseload energy source that can meet net zero goals while powering the massive data centers required by the AI boom. This is why you see so much interest in uranium from users of investing sites and online investing tools. The expectation was that renewables would handle the load, but